Hello and welcome everyone. Welcome to CMA Task. Let's start with chapter number 9.1, that is development of data processing. Data processing is the process of organizing, categorizing and manipulating data in order to extract information. Information in this context refers to valuable connections and trends that may be used to address pressing issues. In recent years, the capacity of effectiveness of DP, that is a data processing, have increased manifold with the development of technology. Data processing that used to require a lot of human labor progressively superseded by modern tools and technology. The history of DP can be divided into three phases as a result of technological advancements: manual DP, mechanical DP, electronic DP. Okay, to understand in simple terms what data processing actually is, we can think of it as a raw vegetable. You cannot eat them raw. You need to wash them, chop them, and cook them to make a dish. In finance term, washing the raw vegetables means organizing the data, chopping them means categorizing it, and cooking it means manipulating it to make a dish, and making a dish, that is our final output, means the exact useful information. So, to summarize, raw numbers means nothing until we process them into financial statements or trend charts. Now moving to the three historical phases of DP. First is manual DP. Manual DP involves processing of data without much assistance from machines. Prior to the phase of mechanical DP, only small-scale data processing was possible using manual efforts. However, in some special cases, manual DP is still in use, and it is typically due to data's difficulty in digitalization or inability to be read by machines. In simple terms, this is the old school way: pen, paper, ledgers, and pure human labor. No machines. We only use it today for outdated physical documents that computers can't read. The second phase is mechanical DP. Mechanical DP processes data using mechanical, not modern computer tools and technologies. This phase began in 1890 when a system made up of intricate punch card machines was installed by the US Bureau of Census in order to assist in compiling the findings of a recent national population census. Use of mechanical DP made it quicker and easier to search and compute the data than manual process. So, the mechanical DP, it made searching and computing data much faster than by doing it in hand, but still it is still not developed in modern computer way. Coming to the last stage, that is your electronic DP. The electronic DP replaced the other two that resulted fall in mistakes and rising productivity. Data processing is being done electronically using computers and other cutting-edge electronics. It is now widely used in industry, research institution and academia. This is what we use today: computers, calculators and cutting-edge digital tech. It minimizes the human error and maximizes the productivity. I hope the three historical phases of data processing is clear. Now let's have a look at figure 9.2 and see how data processing and data science are relevant for finance. There are 11 significant areas where data science plays an important role, which is risk analytics, real-time analytics, customer data management, consumer analytics, customer segmentation, personalized services, predictive analytics, fraud detection, advanced customer service, anomaly detection, algorithmic trading. So let's understand each of the significant area in detail. First is risk analytic. In finance, before you lend money or invest, you must know the risk. Data science uses historical transaction data and machine learning to score a customer's reliability. If a person applies for a loan, the algorithm instantly checks their past credit behavior to see if they will default or pay on time. Business inevitably involves risk, particularly in the financial industry. It is crucial to determine the risk factor before making any decision. For example, a better method for defending the business against potential cybersecurity risk is risk analytics. Machine learning algorithms can look through historical transactions and general information to help bank analyze each customer's reliability and trustworthiness and determine the relevant risk of accepting or lending to them. Now coming next to real-time analytics. Prior to significant advances in data engineering like Airflow, Spark, and cloud solutions, all data was historical in nature. It was processed in batches, which meant that no analysis could be performed until a batch of data had been gathered within a predetermined timescale. Consequently, any conclusions drawn from this data were possibly invalid. Thanks to dynamic data pipelines, data stream, and speedier data transmission between source and analyzer, businesses can now respond quickly to consumer interactions. Earlier, we used batch processing, which means we collected data for a week or a month and then analyzed it. By the time we got the report, the data was already old history. Today, using tools like Spark and cloud pipelines, data is analyzed instantly as it happens. Think of live stock market feeds or instant credit card approval. These are all real time analytics. Now, coming to the third significance, that is customer data management. Data science enables effective management of client data. In recent years, many financial institutions may have processed their data solely through the machine learning capabilities of business intelligence. Text analytics, data mining, and natural language processing. Data science is well equipped to deal with massive volumes of unstructured new data. If we will see, in today's world, financial data isn't just numbers in tables anymore. It includes email, social media feedback, and customer chat logs. Data science uses the natural language processing and data mining to read these text files and understand consumer sentiment automatically. Consumer analytics. In a world where choice has never been more crucial, it has become evident that each customer is unique. Nonetheless, there have never been more consumers. The contradiction cannot be sustained without intelligence and automation of machine learnings. Insurance firms are using real time analytics in conjunction with prior data patterns and quick analysis of each consumer transaction history to eliminate sub zero consumer, enhance cross sales, and calculate a consumer's lifetime worth. So, in consumer analytics, what companies do, they usually use your transaction history to predict your lifetime value. For example, an insurance company uses your historical data to recommend that exact premium you should pay and figure out what other products they can sell to you. Customer segmentation. Customers are frequently segmented based on socio-economic factors such as geography, age, and buying patterns. By examining these clusters collectively, organizations in the financial industry and beyond may assess a consumer's current and long-term worth. See, you can't treat a 60-year-old retired person and a 22-year-old college student the same way. Segmentation means grouping customers by age, location, or habits. For example, bank do their pitches of pension plan to a retiree and a credit card with dining rewards to a youngster. This is how segmentation is helpful. Personalized services. The requirement to customize each customer's experience extend beyond gauging risk assessment. From customer evaluations to telephone interaction, everything can be studied in a way that benefits both the business and the consumer. Natural language processing and voice recognition technologies dissect these encounters into a series of important points that can identify chances to increase revenue, enhance the customer service experience, and steer the company's future. Advanced customer service. Data science capacity to give superior customer service goes hand in hand with the ability to provide customized services. The customer support agent can then cross sell or upsell while efficiently addressing the client's inquiry. See, advanced customer service and personalized service both goes hand in hand. For example, when you call a bank's customer care, voice recognition and NLP tools can analyze your tone and words in real time. The system can instantly prompt the agent's screen by saying that this customer is unhappy about credit card fees offer, or they require some waiver, or this customer is looking for a home loan, pitch our new interest rate. This turns as a basic support call into a sales opportunity and a advanced customer service in a personalized manner as per the requirement of the customer. Predictive analytics enables organizations in the financial sector to extrapolate from existing data and anticipate what may occur in the future, including how patterns may evolve. In the case of stock market pricing, machine learning algorithms learn trends from past data in a certain interval, maybe a week, month, or quarter, and then forecast future stock market trends based on this historical information. So, predictive analytics is all about looking at the past to forecast the future. For stock pricing, the machine learning models take past quarterly or weekly trends, clean the data, and predict the future price movement to help financial analysts make investment choices. Now, coming next to fraud detection. Tracking incidents of fraud such as identity. Okay, I think it should be written as identify theft and credit card scam, and limiting the result harm in is a primary responsibility of for the financial institution. Artificial intelligence and machine learning algorithms can now detect credit card fraud significantly more precisely. If a major purchase is made on a credit card belonging to a consumer who has traditionally been very frugal, the card can be immediately terminated and a notification sent to the card owner as well. Okay, for example, if you are a student who usually spends daily for say 500 rupees, and suddenly there is one transaction in your card of 50,000, which is very unexpected and that is from an unexpected location, the AI flag it as instantly as some fraud and the card is blocked immediately to protect both the bank and the client. Next, on anomaly detection. Financial services have long placed a premium on detecting abnormalities. The method for anomaly identification consists of recurrent neural networks and long short term memory models. These algorithms can analyze the behavior of traders before and after information about the stock market becomes public in order to determine if they illegally monopolized stock market forecasts and took the advantage of investors. Let's understand it in this way. While fraud detection protects individual accounts, anomaly detection protects the whole market. Advanced AI models like recurrent neural networks look at the behavior of stock traders. If a trader buys a massive shares right before a company announced big profits, the system catches them for potential insider trading. I hope you all are aware about insider trading concept. If not, you will be covering the same in your law paper. Now, coming to the last but not the least significant, that is your algorithmic trading. Algorithmic trading is one of the key uses of data science in finance. Algorithmic trading happens when an unsupervised computer utilizing the intelligence supplied by an algorithm trade suggestion on the stock market. This method is known as reinforcement learning, in which the model is taught using penalties and rewards associated with the rules. Based on facts and taught behaviors, the computer can operate in a fraction of seconds without human indecision or thought. Okay, so no human emotion, no panic selling, no hesitation. Computer runs algorithm rules to buy or sell in microseconds. It uses reinforcement learning, which works exactly like training of a pet. If the machine makes a profitable trade, it gets a reward, and if it makes a bad trade, it will get a penalty. Over time, the algorithm learns to make highly profitable decisions entirely on its own. Okay, to summarize today's lesson, data processing has evolved from manual ledgers entry to advanced electronic systems, allowing financial professionals to run the raw data into actionable insights. Today, financial institutions leverage data science for automation, identification of risk and fraud assessment, and tailored customer experiences through advanced machine learning models like algorithm trading and predictive analytics. I hope it is cleared and you can ask your doubts in the comment section below. Thanks for watching.